Hello, everyone. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. Markets are down today. Dow Jones 0.3, Nasdaq is up 0.3 but declining. S&P 500 just turned negative. Russell 2000 down 0.9%. More declining issues than advancing issues. Oil is up $1, and yields are up. Interestingly, we're going to talk all about this. Let's look at our heat map. You can see here that Tesla is down substantially today, 4%. Tesla is down 4% today. NVIDIA is counterbalancing that at 3% increase. Google is up 2%. Eli Lilly is up 2%. Pretty much everything else is down or mixed. Let's move on to a quick note on NVIDIA. NVIDIA stock extends gains on track to notch record high in remarkable 2025 turnaround. NVIDIA shares rose more than 2% early trading Wednesday, with the stock set to notch a new high above its record closing price of $149.43 in January, a remarkable turnaround from the first half of the year. The AI chip maker's stock has made a significant upswing following its first quarter earnings in late May, which featured the revenue that beat Wall Street's expectations and showed the company continued to thrive despite a new export ban on sales of its chips to one of its largest markets, China. Shares had jumped more than 12% since NVIDIA's May 28 earnings report, far ahead of the S&P 500's roughly 3.6% gain in that timeframe. Loop Capital analyst Ananda Barua on Wednesday raised his price target on NVIDIA stock to $250, the highest of Wall Street analysts tracked by Yahoo Finance. The price target suggests NVIDIA's market cap could soar to $6 trillion from its current $3.6 trillion level. Quote, while it may seem fantastic that NVIDIA fundamentals can continue to amplify from current levels, we remind folks that NVIDIA remains essentially a monopoly for critical tech and that it has pricing and margin power, Barua wrote in a note to clients, adding that Loop Capital analysts see the market for AI chips growing to $2 trillion in 2028. To be sure, questions remain over whether AI infrastructure demand will continue to rise as big tech companies rake in far less revenue than they're spending to build the tech. NVIDIA's stock had struggled in the months following its record close in January as President Trump embarked on his trade war and AI competition in China rattled the broader markets. NVIDIA shares plunged in late January when a new chip AI model from Chinese startup DeepSeek prompted demand concerns from its AI chips. Then the stock plummeted again in April as Trump's stiff tariff announcements rocked the stock market. Trump enacted a ban on sales of NVIDIA's H20 chips in China, costing the chip maker $2.5 billion in lost revenue in the first quarter and projected $8 billion loss in the second quarter. At the same time, NVIDIA's competition in the Chinese market was heating up from domestic tech giant Huawei. Huawei is reportedly readying a new advanced AI chip that will be competitive with NVIDIA's prior generation H100 chips. Shares hit their lowest closing price in April 4, ending the trading session just over $94. Let's switch to oil markets. Oil prices have been extremely volatile in the last few days and up about $1 today at $65. This is crude oil, $65, almost $66 a barrel, up from $60 at the end of last year. So it's still up 10% from last month. Let's now switch to Chilean lithium miner SQM begins laying off 5% of the local workforce. Chilean lithium miner SQM has begun laying off workers in its Chilean operations, according to a union memo to workers seen by Reuters on Wednesday. A union source said the dismissals will amount to 5% of its workforce nationwide. SQM employed 8,344 people in Chile and elsewhere at the end of last year, with 3/4 working at the northern Chile operations where it extracts lithium, a key battery material. The memo, dated Tuesday, said the company management had informed the group of president that 25% to 35% of the layoffs would correspond to general roles and the rest to supervisors. As a union, we regret decision taken by the company, etc. Lithium miners worldwide have been hit by a protracted slump in global prices. I think this is due to the slowdown in the EV sales growth across the world. I think hybrids are more popular now, and demand for lithium just isn't matching to forecasts, forcing some companies to pull back on plans and trim workforces, including U.S. firm Albemarle, which is the only lithium miner in Chile. SQM, the world's second biggest lithium miner, also makes fertilizers and industrial chemicals. The company missed first quarter profit estimates. In other battery news, QuantumScape achieves major milestone. Cobra separated process enters baseline production. We're just going to read a summary on this one. QuantumScape has successfully integrated its advanced Cobra separated process into baseline cell production, marking a significant milestone in scaling solid-state battery production. The Cobra platform, designed for faster and more energy-efficient production, represents a 25 times improvement in heat treatment speed compared to the prior generation Raptor process. This advancement brings QuantumScape closer to commercializing its next-gen battery technology at gigawatt scale. Now switching to autonomous driving. Atlanta, the future is here with Waymo and Uber. We're going to read the summary. This is an Uber announcement. Waymo autonomous vehicles are now available on the Uber app in Atlanta, offering electric autonomous rides at no additional cost. Riders can opt in Waymo rides through the Uber app and travel across 65 square miles of the city. Now, the interesting part here is that Waymo is starting off the gate with 65 square miles compared to, I think it's about 10, 20 miles square miles that Tesla's covering in Austin after almost 6 months of focusing on it. So I think Waymo could be scaling faster and in the future than Tesla, but let's see what that happens. Starting today, Atlantas can get matched with a Waymo autonomous vehicle exclusively on the Uber app, bringing together Waymo's cutting-edge technology and Uber's proven platform for a ride that's electric autonomous are all around unforgettable. Okay. Now, Pony AI co-founder is one of the largest autonomous driving players. Pony AI co-founder dismisses Tesla's robotaxi as immature, cites lack of L4 readiness. In a candid interview conducted before Elon Musk's high-profile Tesla robotaxi unveiling, Pony AI co-founder and CTO Lu Tiancheng boldly claimed Tesla has not taken a seat at the L4 poker table. Lu's remarks come ahead of Elon Musk's highly anticipated announcement regarding Tesla's robotaxi. Lu emphasized that Tesla has not yet reached the L4 table, a term he uses to define companies that have achieved both driverless operation and large-scale deployment of their autonomous vehicles. Lu, considered one of China's premier programming talents and formerly with Google's self-driving project, now Waymo, has consistently advocated for the L4 approach, which focuses on fully autonomous vehicle operating without human intervention in defined areas. He believes that L2 advanced driver assistance systems, despite their increasing market penetration, fundamentally differ from the L4 technology, and that the better L2 is, the further away it is from L4. That's interesting. So let's read that again. He believes that L2 advanced driver assistance systems, despite their increasing market penetration, fundamentally differ from L4 technology, and that the better L2 is, the further away it is from L4. I'm not quite sure what that means. Let's see. According to Lu, the L4 table has clear criteria: driverless operation and scalability. He asserts that the only 3 companies globally currently meet these standards: Waymo, Baidu, and Pony AI. He also revealed that Waymo had explored and abandoned L2 technology around 2013-2014 because users often mistook L2 systems for fully autonomous L4 capabilities, posing a significant safety concern. Lu explained that true L4 driverless operation requires a level of safety and reliability that is orders of magnitude higher than L2 systems. Man, this is so good. I'm going to read this again. Lu explained that the true L4 driverless operation requires a level of safety and reliability that is orders of magnitude higher than L2 systems, often taking 6 to 7 years of dedicated development. He highlighted a vacuum period in the industry where significant internal technological advancements occur, but the external perception of the progress remains stagnant because a safety driver is still present. This period, he believes, is why many companies struggle to reach the L4 table. While acknowledging Tesla's seriousness as a robotaxi player and its alignment with some Pony AI's technical judgments, Lu pointed out that Tesla's current deployment of 20 vehicles is very few and does not qualify for the L4 table. He stated that the company needs at least 100 vehicles operating around the clock and open to the public to be considered a serious L4 player. This indicates Tesla's current lag in achieving the necessary scale for L4 operations. Furthermore, Lu noted that Tesla's initial deployment in Austin, Texas, a city with minimal rain and pedestrians, mirrors Waymo's early approach. This choice of location is often strategic for autonomous driving companies, as simpler environmental conditions allow for easier testing and validation of the technology before expanding to more complex scenarios. While understandable, this cautious phased rollout further demonstrates that Tesla is still in the early stages of its L4 robotaxi deployment compared to companies already operating at scale in diverse environments. I mean, this is literally what we've been saying over the last few days since these videos came out. FSD 13 is still making a lot of errors, lots of critical errors that could cause accidents and injury, and maybe even death. And this person says the same thing. Pony AI, which went public on NASDAQ in November 2024 with a market capitalization of around $4.5 billion, has been a steadfast proponent of the Alpha route. Lu and co-founder James Peng have consistently expressed their unwavering commitment to L4, viewing it as a core technology for transforming future mobility, etc. So one day I want to beat Waymo in their home game. Lu also discussed a fundamental difference between L2 and L4, emphasizing that L2 systems still require continuous driver monitoring, whereas L4 allows vehicles to complete all driving tasks independently within a defined operational design domain. He believes that the ultimate goal of autonomous driving is to change the form factor of cars, creating mobile spaces that do not require human drivers. He predicts this transformation could happen within the next decade. Yeah, that's along with my timeline as well, 5 to 10 years. Regarding the impact of AGI, Lu believes that while media attention AGI can amplify public perception, we're going to skip that part. Lu has also touched upon concept of world models, which Waymo introduced years ago. He explained that world models represent a shift from imitative learning to reinforcement learning, allowing AI to explore and learn autonomously in virtual environments. This approach, he noted, is more favorable to companies with internet backgrounds like Pony AI, as it reduces reliance on real-world data and demands a different talent structure. In conclusion, Lu Tiancheng's perspective underscores the rigorous standards and significant investment required for true L4 autonomous driving. He firmly believes that while serious, Tesla's current robotaxi efforts have not yet met the driverless operation and large-scale deployment criteria that define the leading players in the L4 space. Okay. Let's switch to the automotive industry. China auto industry inflates sales by exporting new cars as used. So now this is an argument that I see from Tesla bulls often when we talk about BYD sales, how superior BYD sales. I mean, BYD registered 6 times more cars, new energy vehicles in China than Tesla did in May. 6 times, which is incredible. And I think it's becoming one of the top 3 automakers in the world. And they're just starting to build global production capacity, which is incredible. And so I'm always looking out for news and trying to kind of see why is this such a big deal? I don't quite understand why this is a material piece of consideration. I mean, so what if they're selling their vehicles as used cars as opposed to new cars? If the customers are willing to pay that price for it, what is the big deal? I don't quite understand. China's auto industry has inflated car sales for years through a burgeoning government-backed gray market that registers new cars right off the assembly line and that ships them overseas as used vehicles. These so-called zero-mileage cars have never been driven, but they are being exported as used to markets like Russia, Central Asia, and Middle East, allowing for Chinese automakers to show growth and to dispose of cars that would be difficult to sell domestically. So what? I mean, I don't understand what part of this is an issue, according to Reuters review of government documents and interviews with 5 other dealers and car traders. This is the outcome of an almost 4-year price war that has made companies desperate to book any sales possible. Michigan-based founder of consultancy said. The practice only gained national attention after the boss of Chinese automaker Great Wall Motor criticized the sale of zero-mileage used cars with China in May. On June 10, the People's Daily newspaper condemned the sale of zero-mileage used cars domestically. The paper, which often signals the positions of China's top Communist Party leaders, blamed these fake used cars for driving down prices amid a withering domestic price war, called for tough regulatory action to restore order. But the export and sale of fake used cars is actively encouraged by regional governments in China, according to Reuters' review of state media reports and government documents. Local governments have embraced the practice as vital to meeting ambitious targets for economic growth set by Beijing. According to a Reuters review, blah, 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 Reuters has identified 20 local governments in China, including major export hubs like Guangdong and Xinjiang, that have described their support for the export of zero-mile used cars, publicly available court documents. The tactics include creating extra licenses for the export of zero-mile used cars, fast-tracking tax rebate claims, investing in export infrastructure, and funding networking events to encourage zero-mileage used car exports, the government documents showed. The zero-mileage used car export market works like this. As a fresh car emerges from the assembly line, an exporter buys the car directly from the automaker or from a dealer, registers it with a Chinese license plate, and then immediately marks it as a second-hand car for shipping abroad. Along the way, automaker books the car as sold and logs the revenue. The support for the practice from local governments would make little sense anywhere outside China's centrally planned economy. But here, showing rapid growth in sales and employment can bring about promotion or unlock new funding while missing economic targets that trickle down Beijing can lead to demonstrations of local officials. Because these export firms both purchase and sell a single car, the transaction value is double of that of new or used car purchases. So local governments court them to set up shop on their turf to quickly and artificially boost their GDP statistics, two Chinese auto industry executives said. Sorry, I got distracted by something real quick. I'm going to go back and read the last three paragraphs again. The zero mileage used car export market works like this. As a fresh, okay, we got that part. The support for the local government would make little sense anywhere outside China's centrally planned economy. But here, showing rapid growth in sales and employment can bring about promotion or unlock new funding while missing economic targets that trickle down from Beijing can lead to them. I still don't see anything. Because these export firms both purchase and sell a single car, the transaction value is double that of a new or used car purchases, so local governments court them to set up shop for their turf to quickly and actually boost the GDP. Okay, I mean, so I guess in the local government fiscal situation level, that can be problematic. But the automaker is selling the car once, and whether they sell as a new or used is just a label thing, as long as the price is what it is. So, from a Tesla stock perspective, Tesla stock investor competitive landscape perspective, more people are willing to buy BYDs and other vehicles than Teslas. So that still stands, 6-to-1 registrations. The tactic is only one sign that China's car industry, the world's largest, is allowing production to outpace demand, driving a protracted domestic price war and spurring acquisition of automotive dumping abroad. The Secretary General of China Passenger Car Association praised the practice earlier this month during an online panel discussion hosted by Tencent's news portal, saying it was an alternative channel for automakers. Exactly. I agree with this guy. He added that it has also helped to satisfy overseas demand for China-made cars. Exactly. Reuters contacted all the local governments mentioned in this article for comment, blah, blah, blah. Local government support has taken various forms, from simplifying paperwork to allocating extra quotas for local vehicle registrations to setting up free warehouses with zero-miles used cars. Okay, in February 2024, Planning Commission of the southern city Shenzhen, one of China's richest cities, and a tech hub that is home to Huawei and Tencent, pledged to expand these exported zero-miles used cars. Okay. Nearby, the southern Chinese metropolis announced earlier this year that it had created a mechanism to support and accelerate. Okay, Xinmi, a district of Zhangzhou. All right. The practice, oh my gosh, how long is this fucking article? The returns were so good in 2020 that they were able to earn $1,400 in profit off an electric sedan. Criticism has started out on June 7. Chairman of the Chinese automaker Chang Gan called for a crackdown on exports of zero-miles used cars at the Chinese Auto Conference, saying the practice could enormously damage Chinese brand's image abroad. I don't think so. Massachusetts-based founder of consultancy, which provides insights to Chinese EV companies to foreign investors, said the practice could cause foreign investors to assess China automotive sales skeptically. Dumping concerns. The proliferation of new cars being shipped for sale with used tax and reinforcing fears that China is dumping subsidized vehicles overseas at a time when Beijing is scrambling to find export markets outside the US, now heavily protected by tariffs. Some countries concerned that the influx of cars will crowd out local dealers and confuse consumers are starting to push back. We're definitely seeing friction and tension in markets. Okay. All right. I mean, there's nothing in this article. It's all sensational, but there's nothing in this article that changes that BYD and other Chinese automakers selling these cars at whatever the price the buyers are willing to pay, whether new or used, label as new or used. As long as there's 0 miles and they're worth the price they're being paid, then I don't care what the label is. Now, on the other hand, exclusive BYD, this came out today. BYD slows in production, delays capacity expansion at China factories, sources say. So this is very much the situation that Tesla is in today. So let's take a closer look at this. Chinese electric vehicle champion BYD has slowed its production expansion pace in recent months by reducing shifts at some factories in China and delaying plans to add new production lines, said two people with knowledge of the matter. The decisions are a sign that BYD's robust sales growth over the past couple of years that drove it to overtake Tesla as the world's largest EV maker could slow, as it grapples with rising inventory even after offering deep price cuts in China's cutthroat auto market. BYD has canceled night shifts and reduced output by at least a third of the capacity at some of its factories, said the sources, who declined to be named because the matter is private. These previously unreported measures were imposed on at least 4 factories, and BYD had also suspended some plans to set up new production lines, one of the people said. BYD, which sold 4.3 million vehicles last year, mostly in China, has at least 7 car factories in the country and has gathered near 30% rise in sales to 5.5 million this year. This is a stunning number. I mean, Tesla's tracking more like 1.5 million. So this is close to 4 times, more than triple. Reuters was not able to identify the exact scale of the production reduction and expansion suspension, nor to ascertain how long these measures may last. One of the sources said the moves were aimed at saving costs, while the other said they were imposed after sales failed to meet targets. BYD did not comment. Shares of the gained 2.6%, fell nearly 1% late Wednesday afternoon trade after Reuters reported its production cut measures. Data from China Association showed growth of BYD's output has slowed to 13% and 0.2% year on year in April and May, respectively, both of which were the slowest pace since February 2024, when factory activities were disrupted by a week-long Lunar New Year holiday. Its recent price incentives, which reduced the starting price of its cheapest model to $7,800, triggered a broader sell-off in Chinese auto stocks. I mean, this is incredible. $7,800 for a vehicle. That is less than what Tesla charges for FSD software. Okay, and I think BYD includes L2 plus cameras only system in this car for free. So you get the car and the software cheaper than what Tesla charges for the software. A survey conducted by the China Automotive Dealer Association May found that BYD dealers held an average inventory of 3.2 months. Okay, the highest among all brands in China, whereas the inventory level industry-wide was 1.38 months. A large BYD dealer in the eastern blah. As the inventory levels increased, the China Auto Dealers Chamber of Commerce in early June called on automakers to stop offloading too many cars on the. We just read all that. Deepening price competition. Okay. All right. Now, on the other side, Tesla deliveries estimates for Q2. That's going to come out in about a week. I think a week from today. I think Wednesday, July 2nd. Tesla deliveries estimates are plunging, and that's why Tesla put a robotaxi dog on pony show. I think this is a dog on pony show days before the Q2 report. This last week of sales are really important for Tesla. Every quarter, last week is really important. They know it's going to be weak, right? High interest rates, plunging demand perception, a bunch of other factors, rising competition and everything. And Tesla robotaxi is a distraction from deterrent fundamentals, in my opinion. The fact is that the competition is eating Tesla's launch on cars, energy, autonomy, and humanoids. And you can see on Kalshi, the estimates 3 months ago were close to 400,000. At one point, it was above 400,000. And since then, they've been declining very rapidly to now 347,000. That is that's 27% less than last year's 444,000. Okay, so that's a massive drop year over year in Tesla's deliveries. All right. Let's switch to Trump and the Fed. Trump down to 3 or 4 candidates to replace Powell as Fed chair. We have about 5 minutes left. President Trump told reporters that he's actively considering a replacement for Federal Reserve Chair Powell and that he is down to 3 to 4 candidates. I know within 3 or 4 people who I'm going to pick, he said Wednesday. The consideration of Powell's successors comes after repeatedly intensifying pressure from Trump to consider rate cuts. As we know all this, Trump commented, blah, blah, blah. Maybe, just maybe, I'll have to change my mind about firing him. Okay, he's not going to fire him. The comments from the president during a press conference in the Netherlands came as Powell sat before the Senate lawmakers about 38 miles away in Washington for his second day of regular scheduled testimony before Congress. Powell told Senate lawmakers, we can actually read this in the next article, so we're going to skip to that one. Fed's Powell repeats warning about tariffs as some GOP senators accuse him of bias. Bullshit. Federal Reserve Chair Powell said Wednesday that the President Trump's sweeping tariffs will likely push up inflation in the coming months, even as some Republican senators suggested that the chair was biased against the duties. On the second day of his twice-yearly testimony before the House and Senate, Powell said that the consumers will likely have to shoulder some of the cost of the import taxes. Most Fed officials could support cutting rates this year. Powell added, but the central bank wants to take time to see how inflation changes in the months ahead. There will be some inflation from tariffs coming, Powell said, not yet, but over the course of the coming months. Powell noted that the duties will likely cost hundreds of billions of dollars annually, and some of that is going to fall on the consumer. We're just kind of waiting to see more data on that. Some GOP senators criticized Powell, however, for characterizing tariffs as a potential driver in inflation. Senator Pete Ricketts, a Republican from Nebraska, argued that the duties could simply act on as one-time increase in pricing that wouldn't fuel inflation. And Senator Bernie Moreno, a Republican from Ohio, echoed some of the Trump's complaints about Powell's reluctance to cut rates and accused Powell of political bias. A politician accusing the Fed official of political bias is kind of ironic. You should consider whether you are looking at this through a fiscal lens or political lens because you just don't like tariffs, Moreno. So Powell didn't respond. But the Fed chair reiterated that most central bank officials do support cutting the Fed's key rate this year. And Powell added that it is possible that tariffs won't increase inflation by very much. Trump has sharply criticized Powell for not reducing borrowing costs, calling him a numbskull or a fool. Trump has pushed for rate cuts in order to reduce interest costs so the federal government pays on its debt. Yet some Fed officials have pushed back against that view, saying that it's not their job to lower government's borrowing costs. So far, inflation has still cooled this year, despite widespread concerns among economists about the impact of tariffs. The consumer price index ticks up just 0.1% from April to May, the government said last week, a sign that price pressures are muted. Compared with a year ago, consumer prices rose 2.4% in May, up from a yearly increase of 2.3% in April. Yet, most economists on Wall Street expect that Trump's tariffs will lift inflation this year up to 3 to 3.5% by the end of this year. Now, looking at our regional Fed president's commentary again today, Kansas City Fed President Jeff Schmidt says, in my view, we are currently very near to meeting both sides of our mandate. However, monetary policy works with considerable lag. Policy must be set not in relation to where the economy is as much as where the economy is going. This is never easy, and it is not easy now. With all this uncertainty, the current posture of monetary policy, which has been characterized as a wait and see, is appropriate. Certainly, with the inflation of the past couple of years still in people's minds, I will be careful watching the monthly price data for signs of broad-based price increases that might further challenge an already fragile price-setting psychology. The resilience of the economy gives us the time to observe how prices and economy develop. Okay, so he's throwing his hat in the wait and see, no cut for July. Let's look at the plunge in new home sales. Fall more than expected in May, inventory rises. Sales of new U.S. single-family homes fell more than expected in May as high mortgage rates sapped demand, boosting the supply of unsold houses on the market. New home sales unit dropped 14% to a seasonally adjusted annualized rate of 623,000 units last month, the Commerce Department, etc. The sales pace for April was revised lower to a rate of 722,000 from 743,000. That's a massive drop in 1 month, from 743,000 previously reported figure to 623,000 in May. Economists polled by Reuters had forecast new home sales, which make up about 15% of the U.S. home sales, declining to a rate of 693,000 units. Now, that's a massive miss. I mean, that's a 70,000 miss, more than 10%. That's amazing. New home sales, which are counted at the signing of the contract, are volatile on a month-to-month basis and subject to big rivers. We also know the cancellation rates are going higher too. They decreased 6.3% on a year-on-year basis in May. The inventory of unsold homes on the market increased to 507,000 units, the highest level since late 2007. Yikes. 507,000 units, the highest level since late 2007, from 500,000 in April. Mortgage rates have remained elevated in tandem with U.S. Treasury yields amid heightened economic uncertainty stemming from President Trump's tariffs, which have prompted the Fed to pause interest rate cutting cycle. Powell, we already read all that. The average rate on the 30-year fixed mortgage was just under 7% in May. Government, we already talked about the permits and the sentiment. All right, final company-specific news. Shell in the early talks to buy rival BP, according to Wall Street Journal. Shell is in the early talks to buy rival BP. Wall Street Journal reported on Wednesday, citing people familiar with the matter. BP's deposits were up 6.5%. Okay. Shell's were down 3.3%. Talks between the company representatives are active, and BP is considering the approach carefully. BP was valued at nearly $80 billion as of Wednesday, while Shell had a market capitalization of over $200 billion. As we have said many times before, we're sharply focused on capturing the value, blah, blah, blah. Potential terms could not be learned, and the tie-up is far from certain. Shell CEO has repeatedly said in recent weeks that Shell had a very high bar for big acquisitions, and buying back Shell shares was a better allocation of money when asked about the possibility of a BP deal. On that note, thank you very much, everybody, and chat with you all next time. Take care.